All right. Hey, everyone. Thanks for joining us on our third round of doing this. Again, Larry and I started this at 6 o'clock my time in California. Where am I? In Washington State. It's now 3. So this is our third one. We did one targeted at the East Coast and Europe, and a second one targeted at North America, and a third one targeted at the West Coast and the APAC region. So uh, we're having a lot of fun today. Uh, my name is Rex Frank. I'm a founder and CEO of Sea Level Operations. Been at this about 10 years. Uh, our 10-year goal is to work with 3,300 companies over the next 10 years. So that would actually take us to our 20-year mark. But our goal for 2020 was to end it having worked with 500 companies during the first 5 years. And we missed it by a little bit. We're about 485 companies, I believe. So uh, what I've learned from you guys, our community in those 10 years is just mind-boggling to me. So I want everybody that's listening, thank you for everything that you've helped teach us through the years. And Larry, what do you have to say?
Uh, my name is Larry Coburn. I'm the founder and CEO, I guess, of MSP CFO. We are an analytics consulting company focused on the MSP space. Our job is to try to give you actionable information so that you can, after seeing a piece of information, you'll have something to do to improve your business. We've been doing this for about 5 years, which is pretty much when I met Rex at a ConnectWise conference. And while Rex and I have been, or I should say, Sea Level Operations and MSP CFO have had a strong relationship with coaching and data for pretty much the time we've known each other. Excited to do the webinar
I,
today.
I remember when I first met you, your partner. We were at IT Nation in at
The Hilton.
Bonnet Creek. It was Bonnet Creek at the time, and we went over and sat down in the lobby at the Waldorf, and we introduced you. We got introduced, and I didn't know you, and I didn't trust you yet,
Sure.
and yeah, we were talking about how to measure, like, engineer revenue when multiple engineers are touching a flat fee agreement, and I shared my thoughts, and I remember kind of going out on a limb doing that, and it was like 2 weeks later, Larry wants to get on the call and he shows me what he built. And I'm like, oh my God, this guy not only gets it, but he like took it 10 times farther than I had thought about it with what he was doing with it. And that really made me make a decision that I am out of the database business. I'm just going to share everything I know about this with Larry and let him build it. And one of the best decisions I ever made. Sorry, Larry. Getting
No, a little bit more of the backstory, at least from my perspective. I liken it to the old Reese's peanut butter cups when the chocolate and peanut butter come together. We're actually the opposite because you were doing data and coaching, and I was doing data and trying to help people understand their data. And I think we both were happier to have the chocolate and peanut butter separate so you could focus on the coaching and I could focus on the data. And that really worked well for us.
So yeah, anybody's wondering, that was spontaneous. We did not have that conversation, and I just learned something. So in the other two sessions, we did this session. So um, anyway, a couple quick housekeeping items. Well, number one is please use the Q&A in the chat. It's very difficult to do these just talking to a camera without any audience feedback. So even the smallest comments and stuff helps, it keeps us connected to you guys while we're doing this. So we are watching that, and we are looking forward to seeing your thoughts and comments. Second, yes, this is being recorded. We're going to pick the best recording of the three we did today, and that'll be the one that we send out to everybody. So hopefully this is the best recording. But and then, although I was pretty happy with our second one. And then second, or my last item for housekeeping is if you have not received the Excel budget template, because we're going to be looking at that today, please email me at rex at the franks, I'm sorry, rex at sealevelops.com. And rex at thefranks.net is my personal email, by the way, but rex at sealevelops.com. And I will make sure and get that to you during the first part of the webinar so that you'll have it while we're working today. Um, Good stuff. So we're going to launch a poll just to ask a couple of questions. And the first one here is, where are you in your budgeting evolution, right? So we've never had a budget. This is our first budget. This is our second year trying to create a budget and live by it. Or man, we've been doing budgets and trying to manage the budgets for a while. So we're at about 80%. I think 80% beats any of the other twos. So I'm going to go ahead and end the polling at this point. And here's the results. What do you think, Larry?
Interesting that, half the people, this is their first or had not even had a budget. So hopefully we can, any questions you have as we go through this would be interesting.
Yep. So please jump in with any questions. What our plan is I'm going to go through some like what needs to be in your budget or how it needs to be organized. We're going to go through a sample budget template. And again, if you have not received the budget template, drop me an email and I'll get it out to you here in a couple minutes. But and then Larry's going to take over and we're going to talk about a lot of the reports and data that you can find inside of MSP CFO that might help you with your budget, and also maybe even understand when it's time to kind of go back and revisit the budget if something happens partway through the year. So that's sort of the game plan for today. So I'm going to direct this first at the few people that have never made a budget. The first part of it is we really need to understand what your profit centers are, because we need to budget around that and understand what the margins are in each of your profit centers. So the number one, well, we want to break our profit centers. Really, the two main categories are product resale and service delivery. There's a third one if you're privy to the Service Leadership Index, the benchmark that Paul Dipple and Service Leadership puts out. Is there's another category called for application development, but we're not going to really talk about that today. And if you're not familiar with the Service Leadership Index, I would encourage you to go to service-leadership.com and learn about the benchmark. They've got thousands of companies reporting in a standardized format every quarter, and you get back, not only your quarterly and rolling 4 quarters numbers, but you also get back a comparison of how you're doing in comparison to industry average, but more importantly, how you're doing in comparison to best in class, which is defined as the top quartile, the 25% of the most profitable companies that reported to the benchmark that quarter. So it's a really good way to follow and give you some guidance on where you need to make some decisions. So under product resale, in the benchmark, there's 7 or 8 categories, but I'm just going to focus on the 3 that most of the C-level client base actually reports to, which is hardware resale, software resale, and this thing that we call cloud resale. And cloud resale, that's when you're reselling Office 365, or you're reselling a KnowBe4 license, or you're reselling a hosted spam solution, or reselling somebody else's hosted BDR backup offsite storage solution. And there's a difference between that and what Service Leadership calls shared infrastructure. And a lot of times there's a lot of discussion and debate around some of these items, whether it's shared infrastructure, whether it's managed services, or whether it's cloud resale. So the biggest difference is shared infrastructure, which not a lot of our clients are doing. That's why I didn't really put it in this simple budget webinar template that we're talking about. But that's where you go out and buy servers and storage and rack space, and you provide power, cooling, backup, patching, management to some kind of infrastructure. And then you take all the risk that you might be able to sell enough of it to make that be profitable, right? That would be shared infrastructure. If it's a component of your managed services, but you're not really leveraging somebody else's infrastructure, it's just a software license or something, it's probably a managed services cost of goods sold. But if somebody else is taking all the risk and they're saying, hey, for you, for $8 a month, I will give you a shared mailbox and then you resell that for $10 a month, you're guaranteed your 20% margin there. And that's going to be cloud resale, where you're not taking any risk on the margin, right? You just have your cost and your markup and you're good. So also in cloud resale, there's really two subcategories. One is what we call cloud third-party branded, Microsoft Office 365, Azure, Amazon Web Services, AWS. Those are typically third-party branded, where some of these shared mailboxes, it's not Intermedia's shared mailbox or Office 365. It's oh, we're selling it as our branded shared mailbox or our branded offsite data storage, but you're reselling somebody else's. We call that cloud white label. And it's interesting, cloud third party, the margins are much lower, right? When you're selling Microsoft's brand, they can go Google that and get price check you across anybody. But when you're selling your own brand with its own feature set, you can't really get price checks, so their margins tend to be a little bit better. And that's why those two get separated. And then in the other major category, which is services, we've got technical services, professional services, and managed services. And technical services is that ad hoc break fix non-contract work that we do. And that sounds a lot like you get a phone call that says, hey, do you guys fix computers? And you're like, we sure do. And they say, what's your rate? And you say 150 an hour. And they say, great, come fix our computers. And then you end up, making multiple trips. You don't have parts. You got the wrong skill level resource. You don't have any remote tools, so everything has to be done on site. You got a ton of windshield time. Engineers are going on site for a half an hour and driving all the way back to the office. And we're really lucky if you pay an engineer for 8 hours and they can go bill 3 to 4 hours, right? Then you kind of consider yourself doing good. In that scenario, you might have, let's say you have $100,000 of labor cost every month on technical services. We'd be happy if you had $200,000 in revenue, right? That would be about a 2x billing or a 50% labor cost. When we're doing the next one on the list, which is professional services, that's the scope project work. When we're doing scope project work, we're agreeing with the client in advance what the scope's going to look like. We're pre-ordering the parts. After the parts come in, we're scheduling engineers. And because of that, we get a lot better utilization. Instead of billing 2 or 3 hours a day, engineers are often billing between 6 and 8 hours a day, right? Pushing up their utilization. I'm looking for about a 2.5 multiple from an engineer there. Right, if I have $100,000 of labor cost, I'm looking for about $250,000 in revenue, which would be about a 40% labor cost, but it and a 2.5 multiple on their wages. And then in managed services, though, because we're leveraging tools and technology and standardization, and we're not selling hours anymore, we're selling a promise of uptime and a smooth running system. I'm actually looking for that same $100,000 in labor cost for the month. I'm looking for about $400,000 in revenue, which would be a 4.0 multiple or a 25% labor cost. And that's the promise of managed services, and that's why we all want to do that. And but the interesting thing is we need to make sure that we understand what our profit centers are so that we can measure the margins in those profit centers and know that it's working or not working. So kind of over on the right side of the screen, I've got a little bit of a way oversimplified profit and loss statement built out here, where we've got our revenue and our income at the top, and right below that is our cost of goods sold, which would be our product cost, right? If I bought a server for $800, and that would be my cost, and I sold it for $1,000, that would be my $1,000 of revenue. I'd have about a 20% margin on product resale. But on services, I'm looking for a mid 50% margin. I want to pay my engineers $100,000 and sell it for $200,000 or more, right? And that's why it's so important to understand our margins in these different categories. And our revenue minus our costs is going to be our gross profit, and we call that the line, right? You'll hear the term, is that above the line or below the line? When we say that, a cost or expense is above the line, we mean it's in COGS, or cost of goods sold. And when we say it's below the line, we mean it's our revenue minus our costs is our gross margin, And then we subtract out all of our expenses, which we call SG&A, sales, general, and administrative expenses. And that's below the line. And we subtract all that out, and then we have our net profit. So if you're not super familiar with profit and loss statements, that's kind of what we mean there. Um, Engineer labor, it should be above the line in COGS. And we'll talk about that as I get on the next slide here.
Actually, Rex, there's one comment that came in
Okay.
with regard to products. Not only the ones that you white label that are more difficult to compete, but on the same note, the products that are channel only. It really is about the market. The white label is a clear distinction, but also if there are products you resell that are channel only, you're not competing against the client.
Well, and that to me, I think is a key thing in selecting vendors, right? So I'm going to go on a Dell rant for a second. I remember about 10 years ago, I was at a CMP Media. It was called an exchange conference, and one of their big sponsors was Dell. And the guy gets up on stage to talk about their new channel program, and they call it. I remember they called it Partner Direct. And I just remember sitting in the audience thinking, are you partnering as embracing your channel, or are you selling direct? It was like the most ambiguous channel program name I'd ever heard of, but it was perfectly fitting for Dell. I still don't get their channel program, but sorry, back to the task at hand here. So what goes into what bucket? The thing is we got to look at each revenue stream, right? Each penny that comes into your company and decide what bucket does this go in? Is this a product resale? Is it a cloud resale? Or is it a services? And if it's services, is it technical, professional, or managed services? And we got to direct that revenue to the right bucket. And just as important, we need to look at every cost that comes in and make sure it's correlated to the right piece of revenue. And I just want to once again point out Office 365, we see it bundled into the managed services revenue quite often, and that's really not correct. And the problem is Office 365 resale might be at a 20% margin, but your services resale should be at a 55% margin. And if you bundle them together, we're not going to know that we're getting the right margins on our product resale and we're getting the right margins on our services. We're just going to know that instead of a 20% on this and a 55% on that, we're only going to know that we're getting a 47% margin, and it's going to seem low.
Right. And Rex, if I could throw in, you may have a lot of recurring products, not just Office 365, inside of a managed services agreement. So it is really important to be able to identify what you can break out. And when you look, as Rex is saying, and this is really critically important with the budget and with analysis, we actually frequently get the question, what should my overall gross margin be? And I'd say, well, nicest way I can without being condescending, I said, that's a silly question. Because if you sell a lot of recurring products, by nature, they are low margin relative to labor. So you may sit there and say, you know what, I can get into this whole BDR resale business. I'll make some nice money. I'll make 25% margins. It's a lot of revenue. I'll make some nice margins. It's great. Or you can say, I don't want to get in that business because it'll bring down my average gross margin. I would argue you should take the former attitude that you're really not shooting for the overall gross margin to stay high. You're shooting for your product gross margin to stay high and for your labor gross margin to stay high, and to understand them differently. And if you take it to the next level, as Rex is saying about white label versus general cloud services, there's different numbers there as well. So the better you are at breaking everything out, the better you will be about understanding what numbers you're striving for, and what, I mean, quite frankly, to coin a phrase that one of the peer groups use, what good looks like. And good is kind of a granular thing.
Yeah, you made me think about a saying I've heard from multiple sources, but revenue or top line is for vanity, and profit or bottom line is for sanity, right? So
exactly,
I've always kind of liked that saying. And just if you're a service leadership participant, about 3 quarters ago, they added a new line item for hardware as a service as a separate breakout from PR1 or product resale. It's still considered product resale, at least the product resale component. But Haas and SaaS are definitely there's two components to it. One is the product resale, and just because it's recurring does not make it managed services. It just means it's a nice recurring product resale. And then there's the service component. So again, I'm trying to keep an eye on the chat and Q&A if anything comes along. So please jump out. And I always like to call out antivirus as an example, because it could land almost anywhere on your P&L, depending on what you're using it for. So if you've got engineers that have a laptop in your MSP, and you need to put an antivirus on your engineer's laptop, that's a software expense. That's no different than you buying QuickBooks and using it in your business, right? You're buying Office, or you're buying antivirus for your engineer's internal use. That's a software expense. When it's a cost of goods sold is when your client calls and says, hey, I want 100 Symantec antivirus licenses, and you're like, great, and you give them a price, and they say, great. You sell it to them. That's product resale, software resale revenue, and software resale COGS. Yet if you say, hey, we charge $200 a month to manage a workstation, and part of our solution stack is we deploy Symantec antivirus on every desktop, then that's a managed services hard cost or cost of goods sold. So, and that's kind of, I wanted to use that one to really just kind of point out that you have to really consider what revenue is it supporting, and make sure that it's aligning with that. So, all right. So again, every penny that comes in revenue and every penny that goes out is either a cost or an expense, and we have to line them up so that they match up, so that we can understand our margins in each category. And it's likely that your current chart of accounts or P&L is not aligned with whatever you define your profit centers as. And I'll tell you, this one comes up a lot. Like, we have a VoIP program, or we just added a security offering, and there's a tendency to want to say, oh, we have a VoIP profit center, or we have a security profit center. And I'm going to say, no, we still have technical services, professional services, and managed services. And when we're doing a security project, you could track that as a subcomponent of professional services. And when you say we do managed security, you could track that as a subcomponent of managed services, but it's still either technical, professional, or managed services when you have those other ancillary service offerings. So, and I am an advocate, if it's a significant portion of your revenue, you should track it for transparency in your financials. Another common mistake is we see that service labor is incorrectly placed below the line down in expenses, right? We'll see this thing called engineer payroll expense, and it's down in SG&A. We need to do work to figure out where that goes in COGS. And there's a couple of methodologies around doing that with, we at C-level, in ConnectWise, we use the business units, and we align boards with business units. And then as they enter time, we can associate that percentage of their time entry with the appropriate business unit. With Autotask, we use the categories. There's a thing, a relatively new thing in Autotask called categories, and we do a lot of work around the ticket templates and aligning categories so that we can track this engineer entered 100 hours this month, 50 of them were managed services and 20 of them were professional services. So we'll put 50% of their labor cost in managed services. And then we got some spreadsheets to help align all that. Let's see. Another one is that as well, what about a dispatcher? I've got a dispatcher. Is that administrative expense, or is that service cost of goods sold? And that is service cost of goods sold. So is your service manager, your service executive. If you've got a leader running your service department, then they are a service cost of goods sold. So that's all stuff that we need to kind of consider. I generally tell people to look at a detail, right? Run a P&L with the detail of each invoice, each client vendor bill or expense, and just go through them line by line. And you're probably going to find that things aren't lined up in the correct profit center. And It's not fun to go through that and make the changes, but it is something you need to do. And then one other tip here is to really just go through those business credit card statements and make sure that when, most people, they go and they just download it from American Express into their QuickBooks, and they just do a quick mapping. And oftentimes I find that those mappings are wrong. So that would definitely have a big impact on your budgeting process that we're going to get to in a minute here. Revenue versus deferred revenue. We see a ton of misalignment with recording cash as income when it's not income yet. This is with those project down payment invoices. Hey, the client wants us to do a project. Great, we send them an invoice and they prepay for that project, and we put it in December, and then we do all this work in January, February, March. So December looks like an amazing margin month, all this revenue with no labor cost, and January, February, March has no all this labor costs with no revenue, so the margins are terrible. And that's solved with down payment invoices, and we need to learn how to do that correctly. Same thing with prepaid expenses. If you pay for a year's worth of no before, that's a real common one up front. And then, so we have all this expense in whatever month you paid that, and then no expense for it, but all the revenue in the other 12 months, that's a problem. And Larry did a real good job of describing accrual versus cash accounting a few minutes ago.
What I basically said is that, accrual accounting is really managerial accounting. So you understand what's going on in the business. Whereas with cash, it's really much more appropriate for paying taxes. I mean, in your accounting package, it really is just a switch that you flip, or that your bookkeeper flips when it's time to do your taxes at the end of the year and close out your books. One other thing to throw in here also about revenue and deferred that we see a lot is block time one time. Block time one time is really a prepayment for hours. So we don't consider that to be work until it's invoiced. It's sort of the opposite of T&M. You work 10 hours, you send an invoice. It's not when you did the work, it's when you sent the invoice. Well, with block time, it's when the work gets posted as being done and the prepayment is utilized. So a lot of times you really want to pay attention. And the goal here is to, as we have in the last bullet here, have the revenue match the COGS. When somebody's doing the work, that's when you should have the revenue come in. Otherwise, your statements will look upside down for all the wrong reasons. If they're upside down, they should be upside down for the right reasons, because things are not good and you know that you have to dig into them.
So I'm a little off pace, so I'm going to go through some of this a little quick here, but I think learning to manage from a budget is really a 3-year endeavor. I just heard a weird beep. Can you guys still hear me, Larry? Okay. The first year, you're gonna, call Amazon and order your crystal ball, and when you take it out of the box, it's gonna look really fuzzy, and you're gonna think it's broken, but it's really not. And when you plan your budget and then you go through the year and you look back on budget attainment, you're probably only about 60% accurate. The second year, though, that crystal ball starts working a little bit better. And I would expect you to, in December or January, make your budget. And when we get to the next December, you're probably going to find that it was about 85% accurate because you learned a lot. And then by the time you get to that third year, you're going to find that you're about 95% accurate most of the time. You should be within about 5% of your budget as far as budget attainment is concerned. And I've just got a quick note in here. As Paul Dipple always talks about, the higher maturity level companies, they tie their executive compensation to budget attainment. And I'll tell you, if you're ready to do that, you're going to get pretty accurate budgets because people seem to really care about their compensation. So what we're going to do is break out of this for a second. And I just want to talk about the budget Excel template that we sent out to you. And as you open it up, you'll be on a copyright page here. There's some brief instructions. And as we look in here, I want to point out, we're going to put last year's annual total in, and then we're going to adjust our starting column. We're going to look at that in just a second. But I want to keep this simple budget template simple. And I went with a simple calculation on it's kind of like simple interest, which is different than compound interest. I didn't put a compound formula in. I wanted to keep it nice and simple. So I'll show you what I mean. So as we look at the sample budget template here, I got $1.5 million MSP here, and we've got it broken out in these different revenue categories. We've got COGS kind of broken out. And again, this particular template lines up with the service leadership standard. And I know I left a lot of the service leadership fields out. I just wanted this to be simple for people to be able to get going with. Feel free to study the formulas and add to it. And then down here at the bottom is SG&A. Right here in the middle is some margin calculations, both in dollars and percent. And down here at the bottom is your net calculations, both in dollars and cents. And there's a couple things going on in this template that I kind of did on purpose. One of them is, as we look across, we managed to pull off a nearly 13% net profit last year, but in this budget, it very rapidly escalates to like a 25.5% net profit. That's not going to pass the smell test. Nobody's going to be able to really change and improve their profitability that fast. So that's something you want to look at. Another thing I like to point out in this template is there's formulas all over it, right? But if you stick to the blue boxes, you won't be breaking or messing up any formulas that are in the spreadsheet. Those are designed to be the input. And this first column, column B, really is what you attained for 2020. And then, but you're going to also then put in the monthly starting point. So for example, I've got that we did $60,000 in hardware resale, which was $5,000 a month. And so I want to talk about that simple calculation real quick. I'm saying we're going to take that $5,000 a month that we expect to do, but we're going to grow it by 5% a month. So this means we're adding $250 every month, but I'm not compounding another 5% on that 5,250. I'm just taking, in a simple way, another 5,250 and adding it on. And that's why these are going up by just the 250. I do have clients that prefer to put a compounding effect into this formula. If that's what you want, feel free to do so. If you look at technical services in this template sample, I expect that our technical services revenue is going to be shrinking. So I went ahead and put in a negative number. Just kind of want to point out that that works. And so on managed services, right now in this template, I'm predicting that we're going to add 20% of that $91,000 a month every month. So it goes from 110 to 128 to 146. Like personally, I don't think that's an attainable. I don't think, I sure would like to have a sales department that could make that happen. From my perspective, that's not going to pass the sniff test. And so, but if you put this here, you got 20% here, you're going to have managed services labor costs that need to also be going up proportionally. And the way you build this is, if you say, well, maybe that's only going to be a 5% increase, but you've still got a 17% increase in labor cost, we're going to have a net profit problem down here pretty fast. We go from 13% down to 0 to losses, right? So as you're working through this, we want to predict what our growth is in not only revenue, but in COGS and in expenses. And let's see, just point out one more thing. Notice I don't have anything here. I've got occupancy expense as my rent. I don't expect it to change. The way these formulas work, if I know in April we're going to go to 3,500 a month, I can change that right here. It'll mess up the formula in this cell, but it will carry throughout the rest of the spreadsheet. And the last thing I want to talk about is the starting point, right? So maybe we did $1 million in revenue this year total, which is the magic $83,000 a month. But that may not be my starting point. Maybe we started last year at 75,000 a month, and we finished this year at 100,000 a month. I wouldn't want to start at my average. I would want to start at my $100,000 month that we did in in December and then project my 5% growth or whatever that is. Once you get your numbers in, zoom out here real quick. This is the data that you enter into your budget, into your accounting system. So, if you had QuickBooks Professional, you would go into budget, new budget, and you would start entering all of this data into your budget. And on the budget analysis sheet, I've got this big yellow bar right here that says, note, you should not be doing this spreadsheet on a monthly basis. Your accounting system should be producing this report for you. Once you input your budget, right, this is what our budget was. As you close the month, it knows what your actuals are, and it will give you this variance report. And that's what you want to study. In this scenario, all of our revenue is at 110%. We're beating our budget. We're under budget on technical services. We thought we would do 5,100. We only did 4,000, so we're at 78% of budget. But across all of our revenue, we're at 110% of budget. I'd like to point out for the color coding on the revenue side, being above 100% is good, so it's green. But on the cost and expenses side, being above 100% is bad. So the green and the red flip. So the red is bad. Good stuff there.
Rex, a question came in.
Yep.
Would you grow product cost of goods sold the same percentage as product sales? Seems like this would be a good reason to have your line of business income accounts line up your line of business cost of goods sold accounts.
So there's two answers to what I think I heard there. Number one, absolutely 100% agree. Your income account should exactly line up with your cost of goods sold account so you can understand the margin of each of those profit centers. 100% agree with that. And usually there's work to do there and some reclassifying of costs and expenses to do to get that to work. But when you do, you get this financial clarity that really helps you make good business decisions. The second part of that question is, should you raise costs at the same percentage you raise expenses? Well, normally we're trying to improve our profitability. So we should typically want to raise our costs at a lower percentage than we're raising our revenue until we get to the desired margin levels. So let me know if that answered your question or not.
Well, I think part of the question was, I think you want your labor to hopefully grow, labor costs to grow slower than your labor revenue.
Yes.
But your cost of goods sold for cloud resale is probably going to move lockstep with your revenue for cloud resale, because that margin's relatively fixed unless you hit breakpoints. And as the units grow, that just grows. They each grow together.
Right. Perfect. Okay. I'm going to jump out of Excel and go back to the PowerPoint here, and we'll let Larry do most of the talking now.
Okay. You want to pop in the quick second poll real quick?
Yep.
So the value of doing a budget is to understand what's going on and keep people accountable. Question we have for everyone is, who in your firm is accountable? So this is a multi-select if you choose to. I think it's multi-select, right, Rex?
It is.
Yeah. Okay. A question came in while we're waiting for that to fill out. I believe you said to let QuickBooks generate those actuals, but are you then updating the spreadsheet?
No. Yeah, so no, I built a spreadsheet to allow you to model what happens to budget attainment as a modeling tool while you're trying to build the budget. But when it comes to doing your monthly budget analysis, you should simply be using the report coming out of your accounting system.
Okay. See how we did on the poll, Rex?
All right, share results.
Okay, so this is good. This is actually a little more than we had in previous ones. That a significant portion show that at least the C-level people, C, not as in
pun intended,
as in the letter C, are highly aligned with meeting budget. But as Rex, you said earlier, it would be nice if sales and service also had their goals and their performance, their compensation, their bonuses were tied to their ability to hit the budget, because it all rolls up. The CEO can't hit their numbers if the service and sales don't hit their numbers. Everybody should be similarly aligned. So the question is, why is budget important? And first of all, the most important thing with budget is so you can plan out your year, so that you don't look at the end of the year and say, oh, goodness gracious, I have $300,000 more in the bank or 2 million more in the bank than I thought I had. That shouldn't be the way you behave. You should have a pretty good idea how you're going to end the year when you start the year. And that includes your ability to plan out what you want to do. Do you want to have new initiatives? Does your budget permit that? Because we believe, I know Rex and I, and there may be others, and this is not a hard and fast rule, but I feel pretty strongly about it. Companies should be profitable. You should have a margin you're trying to hit. And if you can hit that margin, if you're above it, you can actually reinvest some of the proceeds into the business, into strategic initiatives, into some initiatives that might take a while to pay off. Hire a new marketing person, get into a new business strategy, go into all of that. And then once you have that, then you can say, well, now I have the funds to do it, or maybe I don't have the time to do it this year. And as we showed earlier, with about half the people compensating their senior management, that is the senior management that is really associated with a high maturity level company. Different people think about it differently. Service leadership has their numbers they assign to it. Evolved peer groups talk about working towards, up to more qualitative stages. When you have a budget, you're associated with being in one of those better stages. And it's not only important to be mature, to walk tall and understand what you're talking about. Business maturity, no matter how you measure it, is associated with higher profitability. So it's really a trait you need to have to understand, that are you going to be one of the more successful MSPs that has the opportunity to have the exit you need. And finally, as we're going to get into in a moment, if something should happen, you need to know what can change and how that's going to affect your year. So let's go on to the next slide. We talked about, or Rex showed you in the Excel spreadsheet, that you should plan on numbers changing throughout the year. You should have an idea going in. You should say that my 2021 sales is not going to be the same as my 2020 sales. There should be a program to say you're going to pick up X dollars, maybe $1,200 a month in MRR, and put that in the budget, and then tie someone's compensation to hitting those numbers. If you are going to offer VCIO or security or some other service, or you're going to get more into BDRs, or you're going to open up your own white labeled cloud, you should understand how that might change in the budget. And that's going to mean your new year is going to be different than your prior year. When you build it up, you should understand that your labor in the future is going to be a little bit more than your labor in the past. Inflation is very low, but you still provide a cost of living adjustment. You also have merit-based adjustments. You might want to add a new member to your leadership team. Perhaps even you could say, we can get more done with fewer resources as your engineers themselves become more professionally mature. And whether or not you need to offer more product, and kind of make an assessment as to if you need more to sell to clients, and if what you are selling has some margin pressure as well. So these are the changes that you should expect. These are the changes when you build, for example, 2021 versus 2020, you should say that there is going to be some changes. Rex, the next slide.
Yeah, Larry, can we hit on that 3% cost of living adjustment? If you
Sure.
increase your cost by 3%, what do you have to do to your revenue to maintain your margins?
Well, if you want to hit 3X, you have to increase your labor revenue by 9%. Otherwise, you're really just having margin compression and multiple compression. So
Yeah.
I'm sorry.
Yeah, so if we raise our pay by 3% and we raise our billing rates by 3%,
our W2 multiple will go down.
right, and our margin percentage will go down. You have to, it's a 3x factor there. So be careful of that when you're doing your budgeting for sure.
And when you think about it, I mean, this is an entirely different presentation, but C-Level has a presentation on C-Level has a presentation on the 4 levers. Raising prices isn't the only option. A whole different discussion, but just know that you will have to make more money for the work that you're doing if the work you're doing costs you more money. I don't know if that was a little circular.
Yeah. So Brian said, if your raises are at 3%, that's a really good reason to have a 5% COLA or cost of living adjustment in your contracts.
I mean, that is part of it. You raise prices, but also you can make it more efficient and do less work. But yes, that's a great point. Poll number 3. So the question is, did you reforecast last year? So we established that most of you on the call at least have had a budget for 1 year or more. The question now is, given what went on last year, did you reforecast that budget? So we'll just give a minute for that to come through.
We're at 50%. 70%. I'll give it another few seconds, and I don't see any changes. So I'm going to go ahead and end polling and show results.
Well, it's a little, I guess the people that answered didn't really do the budgeting, but of the people that did, of the 60% that did, 2/3 of those reforecast once or more last year. So you do the forecast, and if your sales, instead of doing that example of 1,200 a month, they hit 1,100 a month, you don't change the budget for that. That is just simply missing the budget. If your engineers require more money and you have churn and your turnover is high and your efficiency is low, that is missing the budget. You do not change the budget just so that you can hit it. You understand what you did wrong, and say if it's your first year, the next year you do it, you become a little more understanding of what needs to be done. But last year was different. We'll skip right to the 3rd bullet point here and say that there was a major macro event last year. Last year we had the pandemic. 12 years ago, we had the 2008 recession. 8 years before that, or 7 years before that, we had 9/11. The year before that, we had the after effects, which lasted for quite some time in terms of refresh cycles for Y2K. The point of the story is, it seems like every 8 to 10 years, Y2K and 9/11 were somewhat close together. We have to deal with something pretty bad. So another thing is going to happen. It will not look like the last ones in all likelihood. Hopefully we won't have a war, but you should be prepared for something like that possibly happening. It's not the only thing that can happen. You can lose a major client. If you lose a major client, you cannot operate the business. If you lose 1 or more clients, that represents a meaningful portion of your income. You cannot operate the business as if they had still been there. And if there's some number where you just realize that you're missing the budget by just some very large percentage, I'm not sure what that number might be, maybe 10, maybe even 20%, then maybe it's time to evaluate right on the spot. You had done a poor job. Last year, that 60% right, maybe you want to fix that right on the spot. Last year, we could say it was the pandemic. And finally, if something structurally changes, if you make a large strategic hire that was unanticipated, or there's an acquisition, the strategic hire may be sort of one of those smaller acquisitions where you hire a 1-person shop or anything along those lines that wasn't anticipated, then yes, if you change the structure of outside events with a major macro event, or you change the structure of business, then you do a new adjustment to your budget. Now, it's important to know that last year people reforecast. Some people reforecast more than once. And that's interesting, because what we saw with our clients is that people were very concerned. And this is when we really started focusing on budgeting and trying to convince people to do it. People were very concerned in March about what was going on with COVID. Nobody knew what it was going to look like. So everybody tightened up a bit. And I would argue the smarter ones of our clients, the ones who were a little bit more mature, not only did they tighten up a little, but they then sat back down in a conference room with their team and they reevaluated the budget. And they may have said, listen, we're going to take a hit. Some of our clients won't be able to pay us. They'll go out of business. We didn't know for sure, but let's anticipate that what we thought things were going to be down 10%, 15%. And let's look at the budget. What can we do? what we can do is then we could say, well, let's take a step back. What adjustments can we make? Can we reduce hiring? Or can we, what things can't we change? You still have to pay your rent. Are you going to be kicked out on the street? What they did find then over the summer was that things weren't as bad, and they readjusted again back to where it was. So there are things that you can act quickly on, and there are things that, reducing payroll, maybe furloughing some people, depending on the situation. Is it going to be a case where, you have some C-level players that this is the time to cycle them out, or do you have some great players that maybe you have to invest to keep them if you don't have the work for them? So what we can do, and let's, Rex, can I take control now?
Got time for me to stop sharing, right?
Yeah. I'm going to run through kind of quickly a couple of MSP CFO reports. A couple of MSP CFO reports that we have to walk you through what we think is sort of insight, as we said before, actionable information to give you, sorry about that, to give you the information you need to decide if there's a change. So we're going to look at anonymized data here for a client. And what we have here is our staffing utilization. The very short of it is this shows you how many FTEs you would need to do the work. The way we have the report set up right now is an FTE can put in 6 hours of productive time. No one is productive for 100% of their time. We have a setting, it's right now set at 6. So if there are, in a 20-day month, if there's 120 hours of work done on a board, that means that you needed 2 FTEs. If you have 90 hours of work, that means you want 1.5. So what we can do is use that logic to see over time, are there changes in the amount of FTEs that you need done? Because overall, when you add up all the work, they had gone, when they started the year, well north of 30 hours, 30 FTEs they needed to do the work, dropped down to the mid-20s. So what they wanted to do is went back into their boards and say, where can we reallocate heads? We needed 4 heads on this board. It dropped down to 3.5. Maybe there's somebody I can reallocate or furlough or reduce to part-time in the short term. And they can look at that throughout. Now, one of the things also that we looked at here, and I'm going to run through kind of fast, so we're getting close to the end of the hour, is when things cycle down, if something happens and you feel like work is slowing down, but for some reason your engineers are still busy, one of the sort of things you have to make sure you're not doing is hiring just to eat up your own backlog. So you can see a ticket backlog to see in given months, did your tickets decline? And what that means is you're actually staffing to eat up your backlog, which is not sustainable in the long term, not because new work is coming in. As you can see, obviously with COVID, things kind of evened out a little, but you should be aware of what people are doing work on. And if your backlog gets large, do you want to hire up to consume more of it? You don't want it to be too big. So that's one way to understand where your staffing needs to be and whether if something happens, whether you can make a change to your model. Now, Rex and I had a conversation yesterday, and we worked through a 10 input model based on any number of, based on 10 factors really, as to what your staffing level should be, whether you should hire or whether you should reduce staffing. So another one to look at on that was your gross profit or contribution for labor margins. As I said, these numbers need to be looked at differently. And what you can see is as your labor margins decline, that means you might be overstaffed. The people doing the work cost you more money than they should for the amount of revenue they're generating. It's one of many things to look at, and these generally do line up, but it is an indication that it might be time to reduce staffing somewhat. With regard to this, let's keep moving. Other things that you can look at to find if you need to make changes in your model is receivables. The issue with receivables is that when you look at a P&L, which is what we had in the beginning, that's all revenue. And if you bill a client, that's revenue. When you get paid, it's a receivable, and then when you get paid, it comes off a receivable. When you bill them, that looks fine, but you don't pay your bills with receivables, you pay your bills with cash. So you need to know, do you have clients that might be extending you? And this is something that happened last spring as well. Do you have what we're showing here is, for example, this client typically pays their invoices in 20 days. We looked at the past year and it's always taken 20 days to pay. Now they're extending to almost 2 months rather. Not a tremendously large invoice, but you want to be aware of this. Can you go out and squeeze the money? Because If the revenue looks great, but you don't have the cash in the bank, that's going to be a problem. And you may need to cut back on certain things until these people become current. Some of these are a little bit more meaningful in value. Again, the basic process here is we look at how long clients typically pay types of invoices. And then if they're paying them longer, stretching them out longer than they used to. Another thing to pay attention to, and this will be the last one that we look at here, isn't even so much a budgeting change, but in the same same vein, we want to know when there's a change in the system, a change in your system, a change in how you have to operate your business. So one of the things you can look at is a report we call ticket entry times. And what we're doing is we're comparing when tickets came in the first 2 months of last year, pre-COVID, again, we're using COVID as a breakpoint here, to after COVID began. And what we found, the orange is before COVID and the blue is after, and the number is the hour of the day in military time. Tickets started coming in earlier. Now, if you want to be responsive to your clients, you might want to change some of your staffing models and say, well, not only do I need to have my company staff, I need to understand that I might need somebody who's available at 5 a.m., whether I do that overseas or in a different time zone. My clients are now not commuting to work. They're simply opening their laptops in their guest room. And I need to be able to accommodate that as well. So these are all things that you need to be able to look at your business for changes. Last year was an odd year in the fact that everything happened so quickly and so powerfully, but it really, the changes that we're seeing here are changes that may happen over a longer period of time. That's all I wanted to go through on this. Rex, if you want to go back and put up the splash screen.
Yeah, I will. I just wanted to take a second and notice that the risk management section there, I really wanted to call Larry out for a special thank you and the team at MSP CFO. All the reports in that section that he was just showing you were mostly put there in a very fast response to the data that we as MSPs needed from MSP CFO to try to manage through a tough situation. So just Larry, thank you very much for making that happen.
Oh, listen, we got a lot of feedback from our clients, what would be helpful to them, and it was our pleasure to try to be helpful to them.
And we're watching for the Q&A. I wanted to make a quick offer to everybody, pre-download. I put together a list of decisions that the owner and the service executive need to make kind of in concert as the maturity of the company is increasing. And I'm pretty happy with the way that came out. So if you want it, go ahead and download it at clevelops.com/key decisions. And it might bring some light to the journey, the alignment on the journey from the owner and the CEO toward better business maturity. Also, we're focused on Q&A for the last minute or two here. I haven't really seen much coming in. But if you want any more info from me, you can go to our website and click on the Let's Talk, or go to send an email to info@clevelops.com. We'll make sure we get back to you. Larry's got his email address here as well, larry@mspcfo.com. We're keeping an eye on the Q&A. And so far, we really appreciate you guys giving us your time to listen. We try not to make this any kind of a sales pitch, just to share knowledge and information. So hopefully we pulled that off.
Yep. Thank you, everybody, for being a part of it. This was our third call of the day, and it's been enjoyable.
I feel like this one was the best. This will probably be the recording.
We're the loosest. We're the hardest working men in show business. 3 shows a day.
Oh, so what do we have? So thanks. Brian, I'm not sure what you're saying yes to there. Oh, Larry. There we go. Okay.
Yep.
All right, guys. Well, thank you. Look forward to an email probably tomorrow with the link if you want to share this with anybody else on your team. It'll take me a little while to get the recordings and upload it on YouTube and all that. But thank you so much for this, and look forward to seeing you at the next event.
Thank you, everybody.